Tyler, it's been a while since we made any videos. It's summertime. We're taking a little more time in between our shots, but it's also been a while since we talked about SolarEdge. And well, a lot has happened, and it seems like a lot has happened recently. And probably the most painful thing that's happened for shareholders of the company is how much the stock has fallen over the past few weeks, the past few months, and the past year. We need to hash it out and update everybody with what's going on SolarEdge and where we stand on the stock going forward.
Yeah, it's been like we said a while ago, this could get pretty ugly, and it's been ugly. So let's see where we go from here.
That sounds good. I'll say this, not to bury the lead. I will say I think it looks uglier maybe than it is, but that doesn't mean it's pretty. And we need to get through the nuance of that and talk about it. So let's get to it. I'm Jason Hall. This is Investing Unscripted. Tyler Crow here with me. This video is sponsored by The Motley Fool. We're going to give you some really good insight on SolarEdge, maybe another company or two that we might think are worth buying as well. But we've got a great opportunity for you. Go to our special link with The Motley Fool. It's fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. Go check it out. Okay, Tyler, first thing I'm going to do, because, well, sometimes the carnage is worth taking a look at. Here is what's happened with SolarEdge's stock in 2024. It began the year above 80 bucks a share. Now it's around 25. If we look at it just over the past week, it has not been a good week. It's been a tough run. And here's the one that I think really gets me is if we go back over the past year, a little bit more than a year ago, this was a stock that was over $300 a share. It is a massive 90+% sell-off for the stock. Other videos we've done, we've talked about what's going on with the residential solar market in particular. That's such a big, important part of its in market. It does some commercial distributed solar too, but really the residential market is the core for it. And that market is on the ropes right now. Big cyclical downturn that's really upended demand for SolarEdge's products. What's happened in the past few weeks? Let's start unpacking where we are that's pushed the stock down even more.
Like we said, demand has been down considerably. Cost of financing is higher with higher interest rates. You're not taking out loans to do things like people were when money was cheap. And so as a result, we've seen this kind of precipitous decline across all of SolarEdge's markets, the United States and Europe. And management has been saying this first half of the year was definitely going to be weak. And this was kind of confirmation of a lot of that, because this week we had two basically three, I guess, if you will, for three things that have happened. And we're recording this on Wednesday. So we're not even through the week yet, Jason. Things could still happen from here. But the first,
that's a good point. You never want to say it can't possibly get any worse, right? Because, well, the market will say, hold my beer and show you why you're wrong. But it's been a lot. It has been a lot.
Yeah. So the first thing that came out was there was a management put out projections for the quarter, kind of giving a little bit of guidance before we actually get the earnings results for the end of the second quarter. In addition to that, basically the headline for it was that one of its distributors, kind of the third-party distributors that actually sell it to contractors and things like that, that they were going through bankruptcy and that they owed the company about $11 million, which for a company that does $250 million worth of revenue in a quarter, that doesn't sound awful, at least on a numbers basis. But when you start thinking about like the pain that we've seen, where for the last several quarters, management has been talking about like, well, a lot of our distributors have too much inventory themselves, so we're going to hold back on giving them inventory to clear the channels, if you will, was the thing that they talked about. And that right there was a big blow. Management kind of said, look, margins for the quarter were pretty much zero. And they're probably going to have losses this quarter as well as a burn on cash. And so that obviously,
that's the key. So I highlighted it. I'm going to bring it up again and just discuss it really briefly, because this is a part of the story. So this was the first quarter, right? We saw 200 million in revenue. It was over 700 million in the year ago first quarter. It was one of the last quarters before the tail off really happened. This was the big one, big cash burn, those negative gross margins. So this is the SEC filing that they dropped. I'm going to bring it back up again. So again, they reiterated their outlook here for the second quarter, but this was the thing that they added it, like you said, that they were expecting that it would be about $150 million in cash burn. And I think the combination of this part here, the bankruptcy, PM&M's bankruptcy. It's a Chapter 7, right? So this is not a company reorganizing. This is Chapter 7. Tyler, I believe that's a liquidation, right? So
Yep,
um,
that's
everybody just
wrap it
has to
up
line
and
up and get your attorneys involved, and you fight for the scraps, right? So that's kind of where they are. And again, they reiterated all of the expectations for revenue and margins, and their operating expenses. This was the first time they laid it out in plain English, how much cash they expect to burn. Said $150 million coming off of a quarter where just on the operating cash side, they consume 217 million. So they're talking about free cash, which that's usually lower than operating cash, right? So to me, I mean, that's a glimmer of hope, but it also came with the thing in the press release and the filing where they're issuing more debt, $300 million in unsecured convertible notes. And I think maybe that spooked the market a little bit too, is now they're with the stock down over 90%, they're using secured notes, which essentially the conversion price works out to less than $35 a share. This was a stock that was over $300 a share, 55 weeks ago.
yeah, and it was something that had to be done. They had convertible notes that were coming due next year, and they said, well, let's do this now and kind of rip off the Band-Aid. Unfortunately, obviously the terms for this deal are not as favorable. They actually have to pay an interest rate, or was it 2.25% interest on these convertible notes? So a little bit more cash going out the door than previously.
Yeah, I'm going to bring
on
it
the
up. I'm going to bring it up on the screen, the press release in the 8K when they announce it. So this particular deal is 2.25% interest rate right here. And they're going to use it, like you said, the proceeds of it partly to pay off, to repurchase a portion of its 0% convertible notes that are due in 2025. So I think you're right. They're just kind of ripping off the Band-Aid, so to speak, taking on a little bit higher interest expense as a result. Here's my question for you. Again, definitely ripping off the Band-Aid to make this move now on the convertible notes. So Tyler, I'm going to pull up also the company's balance sheet as well, because I think there's some context about why the company would maybe want to make this move right now. So first thing you can see, there's been a substantial amount of cash burn really over the past year as the company has continued to have to spend some capital to deploy capital into its manufacturing. Operating expenses have been substantially higher than its gross margins. So you burn money when that happens. Revenues have come down so much. It's burned through cash. But you look at that and you think, well, you've still got $680 million. You're getting close to not being net cash anymore. The company also holds a little bit of long-term investments. This is mostly government securities, so they're safe. You just have to hold them to a point that they're worth what you paid for them before you would want to consider selling them. So my question for you, Tyler, think about the balance sheet, think about everything that's happened with the business. I think you and I agree that this is maybe it makes things look worse than maybe they really are, but that can be the case, and it maybe still not be the right time to be thinking about investing in the company. How are you thinking about SolarEdge? We've talked about the condition of its business, its balance sheet. How are you thinking about it as a stock right now?
Well, we kind of talked about this, I think, a few months ago, where management was telegraphing us, being like, look, the first half of this year is going to be really crappy. And it has been, to almost to the word. They said the second half is going to get better, but that maybe still up in the air, because I think perhaps a little bit of that optimism was built around the idea of interest rate cuts that haven't come yet. And like I said, financing costs are still high. One of the things that I think is going to basically precede any significant change in SolarEdge's prospects is going to be an increase in basically lending activity. So when we start seeing home equity lines of credit, when we start seeing second mortgages, things like that, where people use financing to make these sort of purchases happen, when that happens, we'll likely start to see the increase in sales that the management is expecting. Until that actually happens, I don't know if we're going to see much of a change. So if we kind of live in this world where there's higher interest rates, management may need to continue to keep cutting and try to find ways to eke out some form of profitability. The good news was, if you actually looked at their guidance, their second quarter revenue was slightly higher than what it was in the first quarter. Some was expected because, it's seasonal, but maybe it's a possibility where we start to see very, very modest revenue gains from here. As far as the stock, It's all going to be kind of predicated on we start to see a reversal of these trends of low margins, a sclerotic, if any sort of growth in terms of revenue. We might see that in the second half, but I don't know. I'm kind of the opinion now. Like I own the stock. I've written it down, maybe not really anticipating the effect that interest rates was going to have on this company. But I think it's something that I'm willing to hold on to for a while simply because I think the business is good enough to kind of muddle its way through this. And when we get to a point where lending activity starts to pick up again, I think we could see a better business. But I don't think it's going to happen until then. So I don't think anyone has to be rushing out to be buying the dip or whatever because, oh my God, it's 90 down 90%. How much worse could it get from here? It's going to get worse until we see increased lending activity. And I think that could be the thing that we look for in the future as a catalyst that's going to get SolarEdge going again.
Yeah, I think I agree with that. There's one thing that I will add too. I think when it comes to the stock, the one thing we haven't talked about that I think is certainly weighing on most solar companies and a lot of renewable companies in general right now is political pressure in the US. It's being a presidential election year with a very contentious election cycle there, and two parties with very different views on renewables and subsidies. And in Europe, we've seen some political turnover as well that could be telegraphing potential impacts for subsidies for renewables. I tend to think those things end up being overplayed in the long run in terms of the risks and opportunities that they create. I do think it's affecting the stock right now, but that could linger over the stock for a while. So that's one of the things, if you're looking for a quick pop, I agree. This isn't a buy the dip and think you're going to be making money in a few months or a year situation. It could take longer for the cycle to really recover and for the business to fully bounce back and seize the opportunity. So I'm with you. I think right now SolarEdge is a good one to hold. If you hold it, maybe not time to really think about buying a bunch. Maybe dollar cost average if you're really interested in building a position over the long term. It's probably going to work out. But unlike ENPH that still continues to eke out positive cash flow in this ugly environment, SolarEdge's cash burn, if this continues to play out, they're going to have to make some changes to get that under control because their balance sheet was a real strength a year ago and it's still strong, but it's certainly not as strong as it has been in the past. So I think investors should just be really mindful of that too.